Hey, everybody. Welcome back to The Smattering. I'm Jason Hall, and it's been a brutal year for investors. It doesn't feel like there's any stocks that are making money, but that's not the case. There are stocks that are up on the year, and there are stocks that are up on the year that are absolutely worth buying. We're going to get into those in just a minute, but first, thanks to The Motley Fool, we get to do these videos because of our partnership with them. If you're looking for more great stock ideas, go to our link, fool.com/The Smattering, put in some info on the stock, and the Fool is going to give you their 10 best stocks to buy right now. I'm joined by Jeff Santoro. Hey, Jeff.
Hey, Jason. Before we dive in, I want to remind everyone that if they like the videos, hit that subscribe button, like the content, and we really appreciate that. All right, Jason, what's our first stock?
First stock is Kinsale Capital, and this stock is absolutely crushing it. It's up 48% in 2022. Not a household name for a lot of people, but I will tell you, this is a business that what it does might not be exciting, but if you think making money is exciting, this is one you should get to know a little bit better. So first of all, this is the largest pure play E&S, which is excess and surplus insurer. What does that mean? It's all the stuff that the big insurers don't know what to do with, so they really don't do very much. Michael Kehoe, the founder, still runs the company. He came from the former largest E&S by mix company before saying, you know what, I need to found this business that focuses on it. There's too much of an opportunity. It is a winning niche where most insurers just don't like to play. Consistently profitable underwriting, consistently profitable operator, and it's a good investor. Part of the way insurance companies make money is investing that float. They're pretty good at that too, and they're about to get even better with rising interest rates. They keep the organization lean. One of the reasons that they're a good operator, they don't have a lot of layers of management, keeps their costs under control. Data-driven approach to help inform their underwriting. They were built from the ground up for E&S, and there are very favorable tailwinds. Let's talk about this business. Again, it's the largest pure play E&S, but Kinsale is the largest pure play E&S, and as you can see, has less than 1% market share. It is a tiny player in a large industry where it should be able to continue to take market share. You see the charts on the right, its ability to take that growth of the market share and 36% increase in gross written premiums over the past 5 years, turn that into 49% increased operating earnings, growing stockholders' equity. This business is a powerhouse. At the starting point, it's all about underwriting. If you're an insurer, you have to start by being able to cover the cost of your operation and the cost of paying claims and actually have a little bit of money left over. So it's called the combined ratio. And you see right here in yellow, at less than 83% over the past from 2019, 2020, and 2021, compared to its peer group, one of the very, very best. And that 59.8% loss ratio, that's a lot of money that's left over after paying insurance claims that's left over from them premiums. What a wonderful, wonderful underwriter. Talk about the tailwinds. You look at the CAGR growth of surplus lines over the past decade or so, and it's grown at more than twice the rate of property and casualty insurance. That is why Michael Kehoe founded this business. Thinking about the long-term opportunity, rising interest rates mean better returns. The portfolio at the end of the last quarter was $1.8 billion, and it's all in really high-quality investment grade things. The bottom line is those have been the worst things to own because those are the things that have been paying the lowest yield. Interest rates are going up. That's going to mean higher yields on that investment portfolio as it turns it over and as it reinvests cash flow that's kicked off from its underwriting profits. I'm a big fan of this business for the long term. I want to highlight this lastly before we move on to our next stock. Kinsale Capital, since it went public in 2016, again, during a very low interest rate environment, has generated 16-fold returns. That's more than 15 times the returns of the S&P 500 over that same period. We're getting into an environment that's going to be even more friendly for returns for insurance companies. Even with the stock up 48%, Jeff, so far this year, Kinsale Capital to me is an absolute buy right now. What's your stock?
Jason, my stock is Ulta Beauty. And as you can see, similar to your choice here, we have a stock that has actually beaten the market in 2022. Ulta Beauty is up 5.42% for the year, as opposed to the S&P 500's loss of around 16%. So we have a winner, and it's a pretty exciting company we're going to dive into here. What do? They sell beauty and cosmetic products, and they do a really good job at it, mostly targeting women and beauty enthusiasts. So this slide is just a real quick display of 60% of total beauty buyers consider themselves to be enthusiasts, and that accounts for 75% of the beauty spend. And those numbers are even higher in Gen Z buyers. So this is a company that's targeting female customers and targeting young customers. And one of their biggest strengths is their omni-channel offerings. So you see this from a lot of retailers. Ulta Beauty does it really well. If you want to buy their products, you can go online and order them. You can go into an Ulta Beauty store. There's more than 1,300 of them. So in more than 100 so far targets around the country, there are Ulta Beauty stores within them. And I just think that's a brilliant way to get more customers and spread their products out so customers can get them wherever they want. They're going to report their Q3 on December 1st, but their last results were pretty impressive. So this is from the Q2, which ended July 30th. They give 3 years of results in their press release. So you can see here that everything's pretty much heading in the right direction. Comp sales in this year's Q2 looked like they were lower at 14.4% comparatively, but again, that's off of 56% growth in the year before. But comparatively, it can look like it's weakening, but it's just because of it's off of a really strong comparable the year before. So they had the year with COVID, they had a really, really strong year kind of recovering from that. And then they're still putting up 14%. Gross profits improving. Expenses are increasing as they always do, but not that much compared to the revenue. Operating income's heading in the right direction, earnings per share, everything. So they're really, financially, all of the big metrics are heading in the right direction. I think their biggest growth driver is going to be this loyalty program that they have, 37 million members, and they drive 95% of their sales come from these reward shoppers. And in that Q2 we just talked about, that number was up 10% year over year and ended the quarter at 38 million. So I expect we'll see that to continue to increase as they report in a few weeks here for Q3. And 2 slides here on valuation. So even though the price is up year to date and they're beating the market pretty handily, it's actually not as expensive as a stock on a valuation basis as it was when the year started. It's easy to conflate stock price and the stock has gone up, and then thinking that the valuation has gone up and it's more expensive. That's actually not been the case with Ulta. It's a little bit less expensive on a valuation basis, even though the price has gone up. And if you look at the long term, this goes way back to 2017. They are actually trading below their historical average, which was around 30 here. So on really any kind of way you look at it, they are cheaply valued compared to where they've been. And I think that makes them a really compelling buy right now.